Hi, this is J.R. Crooks for Money Markets TV. At his press conference last week, European Central Bank President Mario Draghi denied reports that the ECB would buy the government bonds of peripheral Eurozone nations. The central bank did announce an interest rate cut of 1/4 percentage point, and it will accept lesser quality collateral from banks in an effort to increase liquidity. But Draghi drew the line at becoming the bond buyer of last resort. Unfortunately, many analysts believe that the euro cannot survive unless the ECB steps in with a massive quantitative easing program. So when the bank's president explicitly ruled out that possibility, the shared currency took a tumble. Within half an hour, it had fallen from well above 134 against the dollar, all the way down to 133. But it wasn't just the euro that reacted negatively to Draghi's comments. Bond spreads widened across Europe, and the yield on Italy's benchmark 10-year government note, the indicator I view as the canary in the coal mine for the sovereign debt crisis, surged sharply higher. By the end of the day, it was back up near 7%, the same level at which Ireland and Portugal were forced to ask for bailouts. Italy is clearly going down the same path as those countries, as well as Greece. That was confirmed last week when Prime Minister Mario Monti pushed through a draconian plan named Save Italy. It hopes to raise 30 billion euros from spending cuts and new taxes, including a property tax, a new levy on luxury items, an increase in the value-added tax, a crackdown on tax evasion, and an increase in pension age. The plan is making bureaucrats in Frankfurt and Brussels happy because it demonstrates that Italy is getting its house in order. A powerful and disciplined austerity program will put Italy back on the road to fiscal health and growth, right? Well, actually, that may not be the case at all. In March of last year, Greece was forced into a similar budget that was supposed to be the medicine for revival, but instead, it turned into an economic suicide. Tax hikes and wage cuts caused revenues to plunge, unemployment soared, debt jumped from about 120% of GDP to 170%, and the Greek 10-year bond yield exploded from around 8% to more than 30%. So I'm not sure why we should expect a different outcome from the new austerity plan that technocrats tell us will solve Italy's problems. If anything, Europe's liquidity situation and the prospects for global growth are even worse now than when Greece implemented its plan. Instead, I believe that Italy's austerity plan will yield similar devastating results and will ultimately spell the end of the euro as a single currency. You still have time to reduce your exposure to European debt. Just keep an eye on the canary in the coal mine. I'm J.R. Crooks for Money Markets TV. Thanks for watching.